Greetings, everyone. Happy Monday. It's the weekly economic update for September 19th, 2022. Hope everybody had a fantastic weekend out there. I watched a ton of football. A little disappointed in the U of H. They threw up a stinker this weekend. I didn't even watch most of the game, unfortunately, but definitely some good games. Florida State played well Friday, and the Texans, gosh, offense is terrible. What do I have to say? Anyways, if it's your first, you didn't come here to watch or listen to me ramble about football. And hey, the Astros did really well too. They did lose Saturday, but all in all, pretty good stretch for the Astros. Looks like they're going to wrap up home field for the AL. So yeah, another hopefully Super Bowl World Series run in it for them. So let's keep our fingers crossed. All right, if it's your first time watching, please give me a big old like, share, subscribe, slam the notifications, all those buttons so that you know when I'm talking, because sometimes I say something smart. Not always, but sometimes. Anyways. All right. Well, let's go ahead and jump in and take a look and see how the markets did today. Looks like much better. The Dow was up almost 200 points. It's kind of back and forth in the red this morning. I was kind of wondering which way the direction was going to take us, but looks like it found the green for at least a short bit. So the Dow Jones was up 0.64%, or like I said, 197 points, closed at 31,019. S&P 500 was up 0.71, closed at 3901. NASDAQ was up 0.76, closed at 11,535. Small caps are up over 1%. The VIX fell 2.02% today. It's currently at 2577. Let's see here. Canada was up 0.91. Brazil up 2.38. Mexico basically flat, up 0.04. Well, it just said 6, but now it says 4. Let's see here. Germany, jumping across over the Atlantic, was up 0.49. UK, they were closed today, probably for the state funeral, looks like. France was up 0.26. Euro Stoxx was flat at up 0.03, or I'm sorry, down 0.03. Netherlands was up 0.09. Spain up 0.11. Italy up 0.13. Switzerland flat at up 0.06, and Portugal down 0.11. Both Russian exchanges were in the red, but slightly. The MOEX was down 0.04. The RTSI was down 0.19. Moving further east, see a lot of red across Asia. Japan was down 1.11. Australia down 0.28. New Zealand down 0.09, so basically flat. The Shanghai was down 0.35. The SESE component down 0.48. One bright spot in China, the China 50 was up 0.43. The DJ Shanghai down 0.43. And the Hang Seng was down 1.04. And the Taiwan weighted came in down 0.93%. So kind of a mixed day across the globe. But for some reason, I imagine probably a lot of the profit takers out there, or the dip buyers, were jumping into the market today, and that's probably why we're seeing prices in the green. So we'll see. Again, we've talked about it. I think we probably got a lot further to go. I just had a conversation earlier today with a client about this, and my personal expectation, again, this is not, don't run off with this, is because things do change quickly. So something I say today may be completely different than a week from now. But I personally think that, I'd give a greater than 50% likelihood of, well, I don't want to say success, that, this downtrend that we're in will probably continue into next year. And, whether we bottom out at, from peak to trough at, a negative 50%, like we have the previous major downturns, it's too soon to tell. But, hey, we can see. All right, well, let's go ahead and read through the weekly update for this week. The week on Wall Street, a hotter than expected inflation report sent stocks sharply lower last week as investors faced the prospect of more aggressive rate hikes by the Federal Reserve for perhaps a longer period. I've been saying that all along. The Dow Jones Industrial Average fell 4.13%. The S&P 500 lost 4.77%. NASDAQ dropped 5.48%. And internationals fell 1.78%. Inflation deflates the market. Stocks suffered their worst day in more than 2 years last Tuesday as markets were caught off guard by a higher than anticipated August inflation report. Really? Caught off guard? Really? Come on. Markets expected the August report to show a substantial cooling of inflation, potentially allowing the Fed to ease up on interest rate hikes. Instead, the elevated inflation number not only undercut those easing hopes, but raised the possibility of a more significant rate hike. On Tuesday, traders assigned a 28% probability of a 100 basis point hike from 0% chance just the day before. Price action remained choppy for the remainder of the week, closing the week with additional losses as global package delivery company, a global package delivery company warned of a worldwide recession. I believe that was FedEx when we talked about that last week. August CPI disappoints. August Consumer Price Index rose 8.3% from a previous year ago, showed a continued deceleration in prices. July CPI was 8.5 and June's was 9.1. Despite moderating price increases, traders were disappointed given the general expectation of a more substantial slowdown in inflation. And I think it actually, for just the month, I think it went up like 0.1 or 0.3. So, I mean, not huge. It is better than going up, 1% or more every month. So, I mean, again, like I said on Friday, it's a victory. It's just not great, unfortunately. So, core inflation, which excludes food and energy because no one uses that, was particularly alarming to investors, which jumped 6.3% year over year. That number was well above the 5.9 rate from June and July. From the market's perspective, sufficient inflationary pressure exists for the Fed to maintain its hawkish interest rate policy for possibly longer than investors had hoped. I mean, how long did you hope? Was it going to be like 3 months and inflation is gone? I mean, I'd personally like to see some deflation because I think the cumulative inflation is probably in the teens at this point. So things that you were buying, in 2019 was 3 summers ago, or almost fall at this point. Things are probably across the, if you just average them all out, probably 10 to 15% higher on, your average goods. So, I mean, yeah, some things are much, much higher and some things are much slower, but some price deflation would be nice. So we get back, maybe to prices from a dollar from a value perspective, or like hours work, things like that, get back down to where we were several years ago. That'd be nice. I don't know why everyone at the Fed and in the financial journalism seems to be so hot and bothered to get have 2% inflation. But 2% adds up over time because use the rule of 72. I mean, your cost of goods double every 35 years. I mean, that's not a good thing. I'd rather have things stay the same or get cheaper over time. All right. So economic data coming out this week. Tomorrow on Tuesday, we have housing starts. Wednesday, we have the FOMC meeting announcement and existing home sales. Thursday, we have the index of leading economic indicators and jobless claims. Friday is the Purchasing Managers Index Composite, or the PMI. Let's see. Got a handful of companies reporting earnings this week. Monday, today, we have AutoZone. Wednesday, we have General Mills. And Thursday, we've got Costco, FedEx, and Lennar. So, and also we got the Fed meeting this week, which, I bet everybody's just wringing their hands, rubbing them together like butters on South Park. All right. Got one white paper that's going out to folks this week. So let's go ahead and read through that real quick. It's titled The Annual Financial To-Do List, Things You Can Do for Your Future as the Year Unfolds, presented by DSA Financial Group. They're pretty smart. What financial business or life priorities do you need to address for the coming year? Now is an excellent time to think about investing, saving, or budgeting methods you could employ towards specific objectives, from building your retirement fund to managing your taxes. You have plenty of choices. Remember, this article is for blah, blah, blah. Number 1, you can contribute more to your retirement plan this year in 2023. The contribution limit for a Roth or traditional IRA remains at $6,000, $7,000 for those who are over 50 with the catch-up. Your modified adjusted gross income may affect how much you could put into a Roth IRA. With a traditional IRA, you can contribute if you or your spouse, if filing jointly, have taxable compensation. Still, income limits are one factor in determining whether the contribution is tax deductible. Check with your CPA, accountant, or investment advisor. I'd be happy to provide you with those income limits. Once you reach 72, you must take a required minimum distributions from traditional IRAs in most circumstances. The IRS taxes withdrawals as ordinary income, and if taken before age 59.5, is subject to a 10% income penalty. Roth 401ks offer their investors tax-free and penalty-free withdrawal of earnings. Qualifying distributions must meet a 5-year holding period requirement and occur after age 59.5. Such a withdrawal also qualifies under certain other circumstances, such as the owner's passing. Excuse me. Employer match is pre-tax and not distributed tax-free during retirement. The original Roth IRA owner is not required to take minimum annual withdrawals. Make a charitable gift. You can claim the deduction on your tax return, provided you follow the Internal Revenue Services guidelines, because they're hiring extra people. They're going to come get you. Where was I? Guidelines, and itemize your deductions with your Schedule A. The paper trail can be important here. If you give cash, you should consider documenting it. A bank record can demonstrate some contributions, payroll deduction records, credit card statements, or written communication from the charity with the date and the amount. Incidentally, the IRS does not equate a pledge with a donation. If you pledge $2,000 to a charity this year, but only end up gifting $500, you can only deduct the $500. Well, that makes sense. Consult your tax or legal counsel. See if you can take a home office deduction for your small business. You may want to investigate if you are a small business owner. You might be able to write off expenses linked to the portion of your home used to conduct your business. Using your home office as a business expense involves complex tax rules and regulations. Before moving forward, consider working with a professional familiar with the tax rules. I'm actually very familiar with this. I do this every year. I write off this space in here, get to write off the utilities, I think the mortgage interest, and the homeowner's insurance, just the portion for this square footage in here. My wife does the same thing for her office next door. So it is definitely a nice little give or take back from the IRS. Granted, we still wind up donating a large amount of money to the Treasury, but every little bit helps. Open an HSA, a health savings account, works like your workplace retirement account. There are also some HSA rules and limitations to consider. You're limited to a $38.50 contribution for 2023. If you're single, $77.50. If you have a spouse or family, those limits jump by $1,000 catch-up limit for each person in the household over age 55. So that's a little bit different than the catch-up rules for IRAs. God, my nose is itchy. If you spend your HSA funds for non-medical expenses before age 65, you may need to pay ordinary income tax and a 20% penalty. After age 65, you may need to pay ordinary income taxes on HSA funds used for non-medical expenses. HSA contributions are exempt from federal income tax. However, they are not exempt from state taxes in certain areas. Remember, we talked about that with like the write-off for the student loans. You might, depending upon what how punitive the taxes are in your state, you might have some money owed. Review your withholdings. Wait, hang on. Pay attention to asset location. Tax efficient asset location is one factor to consider when creating an investment strategy. Asset location is different from asset allocation, which is an approach to manage investment risk. Asset allocation does not guarantee against investment loss. Asset location basically is kind of like your tax treatment around those. So like you have your after-tax money, which you pay taxes every year based upon the growth or the profits that you take in that given year. Then you have your IRAs, which everything is deferred and you pay ordinary income. And then you have your tax-free, which is like your Roths and your investment-grade life insurance and things like that, where you've already used after-tax money. It grows tax-deferred, and all gains and growth are tax-free to you. Review your withholding status. Should it be adjusted due to any of the following factors? You tend to pay the federal government or state government at the end of each year. You tend to get a federal tax refund each year. You're recently married or divorced, and you have a new job with adjusted earnings. Personally, I would. I know a lot of people get real excited about getting a refund from the federal government every year, but all you're doing is letting them hang on to your money, and you could be earning at least a little bit of interest on that money if you put it in, a high yield savings, or hell, if you invested it. Granted, with the market the way it is, maybe equities aren't the right place to stick that cash at the moment. But over time, the government's just getting a free ride with your cash. I'd rather write them a check for $1. That would be like the perfect. If I were able to, get it just perfectly so that my withholdings were exactly the amount and that I owed them a few pennies at the end of the year. It doesn't always work out that way. It's usually a few grand. But anyways, and getting back several $1,000s is just ridiculous. I mean, that is, in my opinion, a bad idea. So a lot of people look at it as forced savings, and they take that money and then go take a trip or spend it on something at the end of the year. All right. Did you get married in 2022? If so, it may be time to review beneficiaries of your retirement accounts and other assets. The same goes for insurance coverages. If you're preparing to have a new last name in 2023, you may want to get a new Social Security card. Additionally, retirement accounts may need to be revised or adjusted. Are you coming home from active duty? If so, go ahead and check the status of your credit. Check on any tax or legal proceedings. Your orders might have preempted too. And consider the tax impacts of any upcoming transactions. If you're preparing to sell any real estate this year, or are you starting a business, might consider commissions or bonuses come your way in 2023. Do you anticipate selling an investment held outside of a tax-deferred account? Again, things to be prepared for. So, all right. So those are some to-dos to think through. If you think of anything that, or you have some ideas or something you want to talk about, feel free to give me a call. All my information's at DSA Financial Group. Alrighty, well, let's go ahead and read through today's market recap. And then I got one other article about I-bonds. We talked about that earlier in the year. S&P 500 cuts losses as dip buying helps tech move off lows. S&P 500 cut losses Monday amid dip buying in tech stocks, though an ongoing climb in Treasury yields kept the rebound in check ahead of the Federal Reserve's interest rate decision due later this week. Tech moved off session lows after falling more than 2% as the two-year Treasury yield jumped to an 11-year high on expectations for the Fed to deliver a 75 basis point hike on Wednesday and signal that further tightening will be required to rein in inflation. I feel like this is a broken record at this point. Quote, we expect the FOMC to raise rates by 75 bips and deliver an unambiguously hawkish message. Anyone hoping for a Fed pivot is likely to be disappointed, end quote, Jeffrey said in a recent note. Big tech recovered some losses as dip buyers bought the weakness, helping Facebook and Apple turn positive. Industrials also played a role in supporting the broader market, led by airline stocks as investors cheered signs that the recovery in higher margin corporate travel is nearing pre-pandemic levels. Corporate booking volume for the week ending September 11th was just 17.5% below pre-pandemic levels, according to data from Bank of America. American Airlines, Alaska Air, United Airlines were more than 3% higher. Rising bank stocks helped push the broader market, the broader financial sector higher as rising interest rate environment is expected to bolster the net interest margin for banks. The higher the interest rates go, a little bit higher they put their little spread on top where they get to make their money. Energy cut the bulk of its losses as oil turned positive as easing COVID lockdowns in China stoked hopes about a rebound in energy demand at a time when many are worried about the impact of slowing global growth. On the earnings front, AutoZone fell 2% despite reporting quarterly results that topped Wall Street estimates, driven by strong performance in its commercial business. Crypto-related stocks were on the back foot as Bitcoin fell below 19,000 to its lowest level since 2020 before paring some losses. Coinbase Global and MicroStrategy Incorporated were down more than 8 and 3% respectively. In other news, Take-Two Interactive Software cut losses after confirming reports that a hacker released gameplay from its upcoming Grand Theft Auto 4 game. Roman numerals trick me up sometimes. Though the video game maker said the hack wasn't expected to impair the game's development. So, again, not so terrible news. Everyone's probably going to be, with the Fed meeting this week, which is probably going to dominate the headlines. Most people are probably, I think most people would be okay with either a 0.75% or a 1% bump in the interest rate. Anything outside of that, if they only did 50 basis points, I think, the market would take that as a sign of weakness and would probably lead to a faster slide down. This might give some people some hope, but like I said, really right now you just have a lot of dip buying. I imagine a lot of these people who are snapping up good deals today will probably dump them here in the very short future. And if you're sitting on something like especially tech, it's going to be a real bumpy ride in my opinion right now. All right, the last article here has to do with buy I bonds now at 9.6%. A new rate comes in November. One of the best current deals in the bond market, Treasury Series I Savings Bonds, is likely to get less attractive in November when a new rate on popular investments is set. Individual investors may want to snap up the inflation-linked I bonds before the end of October to get the current 9.6 interest rate for the first 6 months. The new rate applying to bonds purchased in November is likely to be closer to 6. Still not bad. Barron's estimates based on the formula used by the U.S. Treasury to calculate the semi-annual rate. The main drawback of I bonds is that individuals can only purchase $10,000 a year, although an additional $5,000 can be bought using proceeds from federal tax refunds. And Americans who own certain businesses can purchase $10,000 annually in I bonds through those entities. The I bonds need to be bought directly from the Treasury through its Treasury Direct program. Anyone out there wants to get some? Let me know. I know I covered this several months back, and there was a white paper that I had that had all the details of what website to go to, how to register an account and fund it, and then go ahead and get those. So let me know if you need some help with that. It's the only bad thing about them is I can't necessarily just purchase them for someone's investment account that I personally manage. Jumping down, the new did I skip anything? No. The new rate to be announced in early November is based on the CPI index from March through September. Barron's calculates that consumer prices were up 3% March through August, the most recent report. Assuming little change in September prices, the new rate should be around 6%. Investors who bought I bonds before November 1st will get the 9.6% rate for the first 6 months. They hold the bonds, and then the new rate for the next 6 months. So then, basically, you get if you held them for a year, you get the average of the two. Two nice features of I bonds are that investors can defer paying taxes on the interest payments until maturity. I bonds can be held for 30 years, and I bond interest, like that on other treasuries, is exempt from state and local taxes. A contrast with bank CDs and corporate bonds. A risk with I bonds is that inflation declines and results in lower interest rates in the coming years. That's a distinct possibility with the markets discounting inflation of about 2.5% over the next 5 and 10 years. But if inflation stays stubbornly high, I bonds will look particularly good. So that's some, it's kind of good news, bad news. With inflation looking like it's slowing down, again, if we had a Fed president or Fed chair that actually had a spine, not like the last two we've had, which have been just nothing but lackeys for the whoever's in the administration. We might not be in this situation in the first place, but if they had raised rates up much quicker, we probably could have squashed this a long time ago and had moved on. Yeah, would the market have probably not liked it very much? Possibly, but do you want pain for a long time, or do you want pain for a little bit? It's kind of like when I've been sick in the past, where you have a cold or whatever. I just lay in bed, get under the covers, and sweat that thing out, and I'm usually back to normal within about 48 hours. Other folks, they just keep, it just lingers and lingers and lingers, and then they wind up with pneumonia 2 months later, and that's no fun. All right, well, that's everything I had for today. I hope everyone enjoyed my amazing broadcast. Was it good? Yes? No? Maybe? I don't know. Oops, sorry, hit the mic. You can tell I'm feeling a bit better today. Got a new lumbar support here behind my back, and while my back is still barking, I'm not in extreme pain, which is making my blood pressure go through the roof. So that is a good thing. So anyways, all right. Well, if anyone needs anything from me, please go to dsafinancialgroup.com. All my information is there. If you want to book a meeting, drop me a phone call, send me an email. Feel free to do so. I'll be back tomorrow with the Liberty Call and whatever exciting news comes down the pipeline then. So hope everyone has a good night, and I'll talk to you then. Bye-bye.